You know, every company out there is trying to sell you on some big story. But its profit and loss statement, or P&L for short, well, that tells you the real story. Today, we're going to learn how to read between the lines and find out if you're dealing with a keeper or a total villain.
Let's be real for a second. Investing is a lot like getting into a serious relationship. I mean, you're putting your hard-earned money on the line, hoping for a beautiful future together. So, what's the P&L in all this? It's the company's dating profile, and we are about to judge it harshly. All right, let's do this. We're not just casually swiping left or right here. Oh no. We are doing a full-on background check. From that flashy profile picture they lead with, right down to the deep, dark secrets they've got buried in their financials.
The cool thing is, every P&L pretty much tells its story the same way, from the top down. So we're going to start with that surface-level attraction, that big, sexy revenue number, and then we're going to peel back the layers one by one to see if we've actually found a catch, or just another financial catfish.
Okay, first up is what we call the top line. This is the very first thing you see, right? The bold claims they make right at the top. But, as we all know, looks can be very deceiving.
So, revenue is that flashy headline on their profile. You know the one, I made $1 billion last year. And yeah, it sounds super impressive, right? But it's kind of like someone bragging about their salary without mentioning their crippling mountain of debt. It's just the start of the story, definitely not the end.
Gross margin. This is where we get the first real hint of their personality. It shows what's left after the direct costs of making whatever they sell. A high margin? That's a great conversationalist. They're engaging, efficient, they have substance. A low margin? Yeah, that's the person at the party who only talks about themselves. All flash, no depth.
Now we're getting personal. We are digging right into their lifestyle, their day-to-day spending habits. This is where you find out if they're actually responsible and building a future, or if they're just, living for the weekend.
You see, operating margin tells you how well they run the whole operation. We're talking salaries, marketing, rent, the whole shebang. Now, if this margin is growing as the company gets bigger, that is a fantastic sign. They're getting more efficient. But if it's shrinking while sales are going up, that's a huge red flag. It means they're spending more and more just to stand still. They're losing control.
All right, we've seen the profile pic, we've had the first conversation, and we've checked their spending. Now it is time for the moment of truth, the bottom line. After all is said and done, what's actually left for you in this relationship?
This is it. This is the number that really counts. Net income is what is actually left in their wallet after every single bill is paid. This is the money for date night, for building a future, for everything that really matters. Because a company with huge revenue and zero net income, that relationship is going absolutely nowhere.
And earnings per share, or EPS, makes it even more personal. It takes that total pot of money, the net income, and it divides it up, telling you exactly what your piece of the pie is for every share you own. Think of it as your allowance in the relationship. Is it growing, or are you getting stiffed?
Okay, so we've read the official profile. Now it's time to go searching for the lies. Because let's face it, every company has baggage. Our job is to figure out if it's just a small carry-on or an entire shipping container full of drama.
So what separates a keeper from someone you should ghost immediately? Well, a keeper has expanding margins. They have consistent profits. The one you ghost, their margins are shrinking. Their profit was a one-time fluke, like they sold their grandma's car or something, and they are drowning in debt.
And hey, here's a little pro tip for spotting that hidden debt. Return on equity, or ROE, can sometimes look amazing because it's being pumped up with borrowed money. It's like they're flexing with a fancy sports car they can't actually afford. So to call their bluff, you check the return on assets, or ROA. If there's a massive gap between those two numbers, it probably means they're using a mountain of debt to fake their success.
All right, theory time is over. Let's put these new skills to the test with a real-world profile. Everybody, meet Company X. Let's swipe through their financials and see if they're even worth a second date.
Okay, so Company X, revenue of $100 million. Nice profile pic. A 40% gross margin. Okay, they've got some personality. The 20% operating margin shows they're not totally reckless with their spending. And that 12% net margin, that's what's left for us. A 12% ROE is pretty solid too. So on paper, Company X is looking like a pretty good catch. But is it consistent?
And that question brings us to a really crucial piece of wisdom from the ultimate financial matchmaker, Benjamin Graham. One good year, just like one really good date, it doesn't mean a thing. We're not looking for a short-term fling here. We want a long-term partner. We need stability.
So before you even think about committing, you got to run through this checklist. Is their growth actually real, or are they just buying friends with a huge marketing budget? Are they getting more efficient, or are they getting sloppy? And maybe the most important question, is this profit stable, or was last year just some lucky break?
So there you have it. You now have the tools. You can read any company's financial dating profile and see right past the flashy photos to find out who they really are. The only question left is, are you ready to start swiping with confidence?